Welcome back to my channel, Balance Sheets Matter. In this video, we're going to be looking at Wendy's and do a stock analysis on them because Wendy's has been popping up on the radar of a lot of value investors as they've fallen from the mid $20 price range and pretty much been in free fall for the last couple years down to under $10, now sitting at $6.76 at the time of doing this video. And they're also popping up on the radar of a lot of dividend investors since they do have a relatively high dividend yield of 8.26%. So in this analysis, I'm going to go over why they've basically been falling, if their dividend yield is safe, if they're a value trap or not, and if they're not, when might be a good price to basically buy Wendy's. But before we get into the stock analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you like looking at individual stocks and want to find good stocks to potentially buy or value traps to avoid, make sure to subscribe to the channel and also like the video, please. And with that, let's basically get into the Wendy stock analysis. So one of the first things people see and start getting attracted by is this low PE of 7.95. But the one basically problem with that is the forward PE is sitting much higher at 11.72. And this is based on a combination of the analyst estimates along with the guidance by the company itself. Because this comes up to basically the first problem with Wendy's is they're having a lot of problems right now of that basically inflation's and or at least food inflation has been hitting their margins, and they're starting to planning to shut down some underperforming stores, which is, I think, going to account for about 5 or 6% of them. And this is why their earnings are going to drop. So this company is really not currently in a growth phase and is in a contraction phase. And you have to realize when companies are even just flat, that does garner them a much lower PE, and especially if they're in a contraction phase as well, that it might even mean a lower PE is going to be suitable for them. And then with that, we also basically have to look at the dividend yield, because right now the dividend yield is sitting at 8.26%, the 0.75% payout ratio. So while it does basically look attractive, it doesn't necessarily mean it's safe, since if they're not going to be able to make the money going in the future, well, that's going to be a problem. They may have to cut the dividend again, since they actually did cut the dividend already once, and it wouldn't be surprising basically to see that happen again. So let's look at basically some of the top line things here. You can see that the revenue, when they did actually fluctuate from this, more 2013 going down to 2017, this was not because they were actually contracting in stores. It's because they had a lot of corporate-owned stores, which they moved to franchise-owned stores. And this is one basically big strength of the business. It is basically a franchise model with almost the vast majority of locations, I believe 95%, being owned by the franchisees. So that does create it so they can have a lot of consistent income coming in without that overhead themselves. But if the franchisees aren't doing well, they may be shutting down stores, and that means basically lower revenue for Wendy's in the future. But this does give them a high probability of staying profitable, at least on the top line, on the gross margin and the operating margin. Because you can see how there has been basically some fluctuations in both of these. Their operating margins actually are sitting pretty healthy right now at just over 16%. But one of the first problems basically that starts popping up with Wendy's is their interest expense. And right now, basically, this interest expense is sitting at $126 million. And that's a really large amount, basically, of their operating income of only sitting at $354 million. I usually like to say you want to look for about a 1 to 10 ratio. And with a company like this, well, we're sitting at a 1 to 3 right now, and they're expecting for their earnings to contract going forward. So this is going to actually start potentially causing a problem if there was any more contraction going forward in the future. Because basically, after we apply in tax and this and that, it only is leaving right now $165 million on their bottom line. And that's 86 cents of basically EPS. And based on the guidance the company has provided itself, they're basically saying the next year it's about 56 cents to 60 cents, which really what that means for these top line numbers here is the net income is going to be closer to 110 million, and this pre-tax income, which is up here, is going to be sitting at 150 million dollars. So what does that actually mean? You can basically take 150 million, add the 126 there, and see they're going to be sitting at 270 something odd operating income. And when you only have 270 million dollars of operating income and you have 126 million dollars of interest expense, that becomes very problematic, because if they were to have to contract any more in the future and lower this operating income, even though they're profitable on the top line, this interest expense actually could make them become unprofitable, or at bare minimum cause them to basically stop some share buybacks or the dividend itself. Because we can see one of the strengths of basically of Wendy's of how they've been returning capital to shareholders, which is one of the reasons it does look like a very attractive company, is they have been buying back a lot of shares. You can see just actually how much they basically bought back shares, with over 400 million shares back in 2011, and they've cut that down to under 200 million shares today. So now let's look at their balance sheet. At least their balance sheet is looking a little bit better, because we can see right now the current assets are sitting at 618 million, and their basically total current liabilities is only 351 million dollars. And I kind of consider Wendy's a little bit of a smaller company now. If you do go look at their market cap, it is only 1.3 billion approximately. And for companies a little bit on the smaller side, if you do get into trouble, short-term financing can really start becoming a problem for you, because you're just considered a lot riskier. So looking at things like the current ratio is much more important. But this is one strength of Wendy's. But we can see one of the basically the large weaknesses is, their long-term debt here sitting at that 2.7 billion. This is kind of pretty much near a high, and they really haven't paid it down significantly at all. It was 2.82 in 2022, but they've really made no progress on that. And that at the end of the also another factor you actually, before I forget, you have to kind of factor in is when you are looking at basically downsizing your store count and getting rid of non-performing stores, basically other issues like your long-term capital lease obligations. Because if you're committed to basically capital leases and you actually want to get rid of those because the areas are good, they're not performing, and there's no one else that wants that lease, you might have to take some write-downs and some losses on that because you've committed to leasing it for a long period of time. And at the end of the day, basically, their total equity is only sitting at 117 million. If we do take out the goodwill of that 774, it's very minor negative, basically real equity on their balance sheet. So overall, at least from the short-term perspective, Wendy's, should be able to, and I wouldn't expect them to have any problems, at least in the next several years, of, basically paying their bills and all their obligations. But we can see there is a lot of basically debt sitting on the balance sheet, which we kind of can see from the income statement is the overall, problem with the company. If we go down to the cash flow, the one positive we can basically say that when we're looking at, a little bit lower net income, is we look at basically the cash flow from depreciation and compare this to the purchase of plant, property, and equipment. And because they're not really in an expanding phase anymore, they're actually depreciating more than they're doing replacing. So even though their net income may actually look basically a little bit lower, in the actual cash flow terms, because they're not replacing as much as they're expensing every time from the depreciation, their actual cash flow is a little bit higher. And, from these few years, you could probably say whatever number we're looking at, maybe their cash flow is like, 50, 60 million dollars more. So when we're talking about, that $110, after, or 110 million after tax in the next year, well, that actually may be sitting a little bit closer to 160 or 170 million. But then now, we're taking that number and you come basically to the next problem is that, well, right now they're buying back $200 million of stock. Well, that's already more than, that amount. And the cash flow from dividends right now, even though they've cut it and they were paying over $200 million before, is down to $130 million. And basically, this is one of the reasons why I think the stock is still going down and the market is kind of starting to price in the potential of a dividend cut. Since if they're talking about potentially downsizing their stores in 2026, there's nothing saying they're not going to basically have to also downsize their stores in 2027 as well. And that really may squeeze things down. And until you really see the stabilization of the company and where they're actually going to stabilize their store count at, you really actually don't know how low and how cheap this company can get because of their debt expense. And the one thing you basically will see is that their net debt issuance, they're really not paying back very much. Like I said, from 2022, they paid back a little bit. They paid $116 million in debt in 2023, then 15, then 3. I would really think right now I would want to be seeing Wendy's paying back a little bit more debt versus paying this big dividend and repurchasing all this stock. So that's the one kind of problem I see is they're going to be next year looking to basically either have to cut the repurchase of stock, which, maybe they've already announced that because you can see in the last quarter here, there wasn't any repurchase of stock, or they might even be having to cut the dividend basically if things don't, look like they're going to be turning up in the future after basically the next year. So 2027 and basically forward. So this is the main primary reason I think Wendy's stock is contracting, because the market really can't see the value. And even if you are looking at a company like this that isn't this contraction, is paying out all this, you would want to be looking at probably at a lower PE. Like I would personally be wanting to see something, below 8 forward PE to really actually say, hey, this is an attractive value. At a 12 PE, like the company in this situation is just does not look that cheap to me. So I'll bring up the interactive chart here. There's not as much to basically look at, but we'll bring up a few of the things I normally do. You can see basically the revenue with estimate. It's even though they're guiding the earnings lower, they're basically, I guess, planning on keeping the revenue relatively stable, according to at least a summary of analysts, although I don't know how accurate that always is. But as we can see, basically the EPS is expected to drop, with the consensus being basically at 58 cents. But even though basically the analyst estimates are to say, hey, this is going to basically pick up a little bit forward in the future, well, that's kind of a standard thing that they do. If you expect the 1 years it's going to be a one-time going down, you actually still project, oh, things are going to start recovering in the future. And again, like I said, we really don't know if this, restructuring of Wendy's, cutting some stores down, is going to fix the problem, or if they're going to basically have to do it another year in the future, which, is probably not only going to have the repurchase of share cut, would also cause a dividend cut. And then if we kind of look on the relative valuation side, you can look at the price to sales ratio here. And let me just pop off the revenue estimate here. And well, it is kind of cheap, relatively speaking. It has been a lot cheaper, in 2008, 2009, when it went down to 0.11. And right now we're at 0.6. So where it's, cheaper maybe in the last 10, 15 years, historically, there has been times when the company was in a lot more trouble and it was a lot cheaper. Even in 2000 here, the company was basically trading at a 0.32. So, there has been a lot cheaper times, the stock has been. And let's bring up the PE, take a quick look at that. This sometimes takes a second to load. And you see we're sitting at 7.95 now. You kind of have to ignore these big blips. But just look up here to basically, as I scroll, to see what it's been. And you can see at the peak here, it was trading maybe around in the 20s realistically. But even before, when we were in 2018 here, there was a time this was trading basically at an 8 PE as well. So that's not even that common and uncommon. And this was more in a growth phase, almost when Wendy's was still going up a little bit. Here again, we were under 20, 25 at about this range. No PE because they were at a loss again, and a 20 there. Oh, and here's an interesting spot around this 2000 here. You're trading at like a 5-6 PE. And that's honestly kind of the actual PE I would want to be looking at Wendy's in a stabilized price to really consider them a value play. So we go over to, the stock chart here, and I think a lot of it kind of speaks for itself, where you may first finding support here, because what jumps out, you see the price volume profile sitting under $5 at this 477 where this previous large consolidation was. And just from a natural technical perspective and kind of a chart there, this is probably where you would want to start looking at support, and you still would probably want to see it base, since if you look at any of these past bottoms, and this is just one thing, it's not obvious just about value, you kind of have to realize there is momentum going against the stock. This was a very long bottoming process until the stock turned around. Even at these ones here, very long bottoming process, very long bottoming process. All these periods of time here, it's multiple years. So Wendy's, may be an attractive stock in the future. I think this concept of waiting it for at the bottom, well, what you're really waiting for at the bottom is you're waiting for basically the company to stabilize itself, stop reducing the stores. And then once you do that, and you can kind of see that, oh, there's maybe a little bit more stabilization, there's a future. Now it's, the value is actually getting a little bit better as the stock price goes sideways. That would kind of be the time I would actually start looking at it. And, that may look something like the stock comes down and, would, pop around here for a while before going up. But, really until that happens and until there's some very clear stabilization that they're not going to be having shrinking basically earnings, and they're going to be stabilizing their store count, and the company's kind of stabilized, I don't see really any point basically of looking at Wendy's and buying them basically at this point. Because if basically the earnings do contract, not just next year, but in the future, like I've said multiple times, their high interest expense is really going to start causing some problems. So, also in this, I'm going to want to basically see them pay back a little bit of the interest expense rather than paying out that dividend, repurchasing the shares, and putting them in a better position. So, a combination of all of those is probably required. I think that's going to take multiple years before they're basically able to achieve that. So, that kind of basically give you some insights of basically what's the problem with Wendy's right now. As you can see, I don't think it's basically at a buy at this point, and it's something that looks like you're actually going to be able to wait on for potentially quite a while further, quite a while longer before the stock actually becomes potentially attractive. But then at a point when it does in the future, it actually can potentially be a good buy, since you can see if you did wait, you did buy it at all these previous bottom points here, there actually was quite significant gains you could basically achieve every time after buying the stock. So anyways, that's my stock analysis on Wendy's. I hope it basically gave you a few insights. We'll basically see right now if it keeps being a short-term value trap, and eventually if that turnaround play does start happening. And if that does start happening, I'll do another video on it. So make sure to subscribe to the channel, like the video, and I will see you in the next stock analysis.